Stocks continue to hit new highs. Are valuations becoming stretched? Are there any bargains left in the market? Joining us are Kate Warren, investment strategist at Edward Jones, and Matt Monty, the portfolio manager at Rockland Trust. Good to have you both. Kate, I'll start off with you. You like sectors outside of technology. What's wrong with tech right now? It's been the market leader.
Well, there's nothing wrong with technology. We just think that any time you get a sector that's up to 26% of the S&P 500, it's a sign that it's run way ahead of the other sectors, and that's an indication that you may need to pull back. We recommend no more than 5% of your equity portfolio in any individual stock. That includes other sectors as well as tech. But more importantly, no more than 20% of your portfolio be in technology. That's why we think you need to look at smaller companies as well as other sectors.
So from the beginning of the year to now, Kate, have you basically pared your tech position simply because of the outperformance of technology?
We've recommended that investors pull back to no more than 20%. So yes, that would be repeatedly pulling back. And the reason is not because we don't like technology. In fact, the valuations are actually still very reasonable.
It's portfolio management.
Compared to how fast their earnings growing. You're just saying you want to be prudent about how you manage your portfolio.
Yeah. Matt, do you agree with that in terms of you know, spreading your eggs out and making sure that you're not becoming too overweight in technology? Or is there such a thing when you've got a sector that has been the clear leader so far this year?
Yeah, I 100% agree with that. We actually equal weight our sectors here at Rockland Trust, so we have 10% or thereabouts in each sector, and so we're well underweight technology. The valuations are stretched in technology, and if you throw Amazon and Netflix into that basket, I know they're in consumer discretionary, they look even more stretched. The technology index is about 20% more expensive than the market. Consumer discretionary is another 10 to 15% on top of that, and you know, you can pick up telecom and financials at 10 to 12 times earnings, and technology is trading up near 19 and 20, and I know that they're growing and all, but you know, there is a certain amount of defensiveness you get in some of those other names with dividends and so forth, and so we are more defensive nowadays than we've probably been, you know, at any time in the last couple of years.
Did I hear you say that roughly 10% of your portfolio is in each of the 10 or 11 sectors of the S&P? Is that what you said?
Yes, that is correct. Yeah, that is correct. We actually take the other 10% for real estate. We do through a separately managed account.
So by definition, then, you are underweight the most highly weighted sectors of the market, and overweight, sometimes by a lot, the least weighted market sectors, right?
Correct. And that weighting structure actually has proven to be a better defensive positioning. And we don't believe you can time the markets, but for our clients, we are a fiduciary. We try and manage downside as our #1 priority. So therefore, having a little bit more in those more defensive utilities and telecom stocks really gets us through those storms when they arise. And no one ever really knows exactly when that is going to be.
So it's been tough sledding during the bull market?
Yeah, no, we've been holding up pretty well, but we're certainly not going to beat the indexes when tech's leading and it's 2.5 times, you know, our weightings. But certainly our individual names that we've selected have done very well relative, and that's helped us.
Kate, your highest conviction picks right now?
Well, I'd be looking at sectors outside of technology, and as I mentioned, I'm definitely looking at small and mid-cap stocks. But if you're looking for alternative large-cap stocks, I'd be looking at companies like United Technology and Medtronic. Both have solid earnings growth, they have good prospects, they have good dividends, which in our view makes them a little more defensive. And in our view, they're ones that have lagged behind a bit, but still have reported above expected earnings growth. That to us says they're poised to continue higher. And we actually think the stock market as a whole is going to continue higher, probably led by technology. So that's why we're saying make sure you're better diversified than the S&P 500 as a whole.
All right. Thank you both. Appreciate it. Kate Warren with Edward Jones, Matt Roddy with Rockland Trust.